In this week's update, silver could be the next real bullet performer, the strongest sectors, and a myriad of opportunities. Which one should we choose? My name's Garry Davis, and as always, this is general, not personal advice. And remember to like and subscribe if you enjoy this video. Okay, the backdrop at the moment, it's just been the most fascinating time that I can recall in more than 30 years in the market. And the economic damage that is being done by the global lockdown of economies is absolutely staggering, and we haven't seen anything like the full extent of what's coming towards us. It's jobs, it's manufacturing, it's housing, it's most services, and here I'm really referring mostly to the American market. The China economy shrank 6.8% in the quarter. That's compared to the same quarter in 2019. US quarterly earnings are forecast to drop by around 9%, and possibly GDP could be as low as could be 20% lower. But offsetting all that, and I don't want to focus too much on that because everybody knows that it's going to be really horrible for a period of time. But on the offsetting side, we've got this incredible global stimulus. We've got $16 trillion worth of stimulus that has been put forward around the world, nearly half of that in the US. And that represents about 18% of global GDP, which is just extraordinary. I mean, this has never happened before, and it absolutely dwarfs what happened coming out of the GFC. We're now seeing China largely getting back to work, and America is certainly working towards a state-by-state reopen, left up to the individual states themselves, but certainly the underlying theme there is that America is looking to reopen their economy as soon as possible. So quite different to what we're doing here in Australia. And another interesting stat that provides a bit of a backdrop is what are the major US corporate insiders doing? What are the CEOs and the senior management and the boards of major US companies doing? Well, they bought in March $1.1 billion worth of stock, which was the largest monthly purchase by corporate insiders in 7 years. So that gives you a bit of an understanding of how they see the outlook. And, you've got to place a little bit of stock in that. The buying of insiders is not always a direct indication of the fact that prices are going to go up. Sometimes they get it wrong, but that's a pretty heavy commitment during a month that was an absolute shocker. This chart, I think, says it all. This is initial jobless claims in the US going back to the mid-1960s, and you can just see that what's happened here, the size and the speed of it is just quite incredible. And that's why this is an event like we've never seen before and hopefully never see again. So let's turn to American stocks. The S&P rose 3%, but the Nasdaq was actually up 6%. Really strong on the back of particularly Amazon, but also Netflix and Google. So all of those stocks are really, really making the Nasdaq surge. And that really goes to the heart of one of the things that I want to talk about today, and that is that we've got this incredible divergence between different sectors in terms of performance. We're certainly seeing it in America. It's less obvious here in Australia because our sectors tend to be dominated by just a couple of really large stocks. So it's not as easy to make the comparisons here. But there certainly is enormous divergence in performance here as well. Now, the rally is still extending upwards. It's gone way beyond what I thought was likely, and I guess what 99% of people thought was likely. And this is really the market looking ahead to the US economy reopening and things getting better. Now, only time will tell whether it's gone too far and we are going to get a retest. And really, I'm not burning up too much energy thinking about, is this going to be a V-shaped recovery, a W with a retest, a very slow sort of U-turn, or are we just going to go down and stay down? Well, clearly the L, I think, is now not in play. because we've rebounded so strongly. My message is really simple. Don't worry about what the index is going to do. Just focus on the outperforming sectors. Find the best stocks in the best sectors that you can. This has been a crash like never before. So why won't the rebound be as equally unfathomable and unexpected as the crash was? That sort of makes some inherent sense to me. Now we're seeing the VIX is definitely easing, but it still remains very elevated around the 40 mark, and 40 is really high. So this is still a very volatile period, and we'll look at that chart in just a minute. Now the US dollar is consolidating around about the 100 mark. It's been fluctuating between the mid-90s and about 103 since this crash happened. And the 10-year yield is steady at 0.65, which is obviously pretty low for the 10-year yield. All right, let's go and look at some charts. We'll start with the S&P. So I've put a Fibonacci scale on here from the lows to the peak prior to the crash. We ran up to the 38.2 and here and had a bit of a pause, but it only lasted a few days. Then we went straight up to the 50%. We had a pause, but it only lasted one day. And then we took off again, and now we're heading towards the 61.8. Now, 61, being able to make it back to the 61.8% level in such a short period of time after a crash of this nature is just unheard of, and it shows incredible buying strength in the market. And you can see that it's moved so quickly that it's just, this green line is the 20-day moving average. The blue line is the 50 and the red line is the 200-day moving average. So it's moved so fast that it's just sprinted ahead of the 20-day, which again, you just hardly ever see. Normally the index will the moving average will fairly well hug the index at the 20-day level, but it's just absolutely roared away from it. So incredible strength in the S&P. Where to from here? As I said, I'm not really too focused on whether we get a retest, which might perhaps come back down and form a higher low, something like that. I really don't know, and I'm not thinking about it. I'm just turning my attention to the strongest sectors, and we'll look at that in just a minute. If we look at the NASDAQ, I don't have that one queued up, but the NASDAQ is certainly outperforming the S&P at the moment. And that's largely down to the performance of stocks like Amazon and Netflix that are obviously benefiting from this lockdown with people at essentially at home. But look, one chart that I do want to look at. This is a relative comparison chart for the US indices, and this is starting the indices at a common point 12 months ago. And as you can see, GDX over that 12-month period, which is the gold sector, has significantly outperformed. Here's the S&P here in green. So GDX has outperformed the S&P by a country mile. XLK is the technology sector, so it's doing slightly better than the S&P on a 12-month basis. And then XBI is the biotech sector, which is probably the outperformer in healthcare. And I will zero in a little bit closer on these to see what has actually been happening in the more recent period. XLP is consumer staples, so you'd obviously expect them to be doing reasonably well. And then right down the bottom, we've got XLY, which is discretionary, consumer discretionary stocks. So obviously they've taken a big hit. And of course, the banks, XLF, have taken the biggest hit. So that's on a one-year basis, but it gets really interesting when you zero in. Let's zero in and look at the last month. So if we look at the last month, you can see that the outperformance is even really more stark. So GDX is really outperforming the S&P by a long way. We've got the consumer staples, biotechs, and technology is starting to outperform, and that's really down to what's happening with Amazon and Microsoft and those sort of stocks. So the order is pretty much the same, but it's the magnitude. You can see just how much precious metals are outperforming at the moment. It's quite remarkable. Okay, now I just want to take a quick look. So this is the VIX. This is the VIX Index. Normally runs around, has been running along below 20 for quite a period of time. We go back into almost to the middle of last year, and we were running between around 12 and 20. Then we just rocketed up into the 80s, and bear in mind these are closing numbers. They actually went higher than this intraday, and now you can see the VIX is coming back quite nicely, but it's still above 40, and 40 is still a very elevated level. So there's still plenty of volatility and plenty of danger in this market yet. Okay, sorry, I just want to look at the currencies before I go back to the others. So let's just look at the US dollar. So we had this remarkable volatility from the mid-90s to 103, and we're now starting to settle down around about the 100 mark. The Australian dollar got absolutely murdered in the middle of the crash, but has rebounded quite nicely, and that I think is largely around what's happening with China. So let's look at the Aussie stocks. 63.5 is where the Aussie dollar finished. And I think this is largely just enthusiasm for China, because it's not really been driven by the US dollar in the last week anyway. Now our index rose by 100 points on the week, which is just under 2%. And we've got many stocks that are rebounding from massively oversold. So the big question is, which ones can be bought and which ones are the ones that are just a trap, waiting to to fall again at the first sign of a turn down in the economy or in the market. And the two things that I'm really focused on at the moment is to make sure that any company that I own has got unquestionable financial strength to get through this period, however long that takes, and are going to prosper coming out the other side. Now that just requires a lot of research and a lot of legwork, but those companies are certainly out there. And the second thing is to make sure that that sector has an enduring tailwind for the next 2 to 5 years. Because there's no point in finding a stock, a really good stock, that is well managed and is in good financial shape, but the sector is just going to be trying to beat into a headwind for the next few years. There's just no point in owning those sort of stocks. You're just sort of hoping. As I've been saying for a long time, safety is not in a stock that pays a big juicy dividend, because that dividend is probably going to be cut or disappear. Safety is not in traditional defensive names, because a lot of those stocks are carrying a high amount of debt, and who knows what's going to play out in this period going forward. To me, safety is in growth, and the most reliable growth that you can get. So therefore, you want to be in sectors that have got those unquestionable tailwinds. Okay, let's go back to the charts. So we'll look at, let's go to the ASX 200. So you can see, as opposed to the US index, the S&P, which is almost to the 61.8% retrace, the Australian market has only made it to the 38.2 at this stage and has stalled. Now that's largely about the banks, and we'll see the weakness in the banks on the next chart. But that and a number of other significant contributors to the ASX 200 are really holding the index back. But at an individual stock level, and I've mentioned these couple of stocks, and these aren't recommendations, but I've mentioned them just as good examples. We've got stocks like A2 Milk hitting new all-time highs. We've got Fortescue very close to its all-time highs. We've got a number of other stocks like Technology One that are close to their all-time highs. There's not that much of a shortage of them in Australia. So there are stocks that are outperforming. But let's just do a quick run through on the sectors. So energy has obviously been hit very, very hard. Financials, you can see not even close to the 38.2, so they've been the real underperformers in the Australian market, and it's hard to see why that won't continue. Healthcare has been a star. It's certainly back to probably the 61.8% level. Materials are almost back to their 50% level, so they've been stronger. So it's pretty obvious where the strength is in the Australian market. And there's the Australian small caps, which really covers a very wide variety of stocks. So that's what the Australian market looks like. Let's turn to precious metals. Gold soared by probably close to $100. In fact, more than $100. But finished up 66 as it declined back below the $1,700 level. It hit a high of 1750 during the week, and we've got a support zone that is kicking in between 1630 and 1670. So for me, I would expect that gold is probably going to hold that support zone. Now, the other thing that I wanted to speak about today was I think silver is offering potentially a tremendous long-term opportunity. The gold to silver ratio is just simply stupid. It's 2 to 3 times worse than it normally historically would be. And all things in the end do mean revert. They go back to the long-term averages. And I think the way things are looking at the moment, silver is probably poised to do what it did coming out of the GFC, and that's outperform gold by a long way. So for me, the potential upside in silver over the next 6, 12, 18 months far exceeds gold. And if we look at the futures market, the number of contracts that are both long and short in the silver futures market are incredibly low, which means that they are both wide open for a substantial amount of buying. Now, I've never seen it where the longs and the shorts are both really, really low. But from this point, and given the way that gold is looking, because silver is going to track gold, so you've got to be bullish. If you're bullish about gold, then you've got to be even more bullish about silver. But the buying is more likely to go into buying long contracts in silver, which is going to fire up that sector even more. But look, the bottom line is that there is a lot of money flowing into silver ETFs, and the largest silver ETF by a long way is SLV, and that money is flowing into SLV already. You can see it in the holdings. So there's a lot of investment demand. Forget the futures market, forget the speculators, they will have an impact. But there is a lot of investment money is flowing into the silver ETF market. But the price hasn't really responded yet. So I think that it's poised to really do something special. And out of the GFC, silver rose by roughly 500% over a period of 2.5 years. So there is enormous potential upside here. But let me hasten to add, silver is very volatile. It's more volatile than gold by a lot, and some investors and some traders may not have the stomach for the volatility in silver. So, this is not necessarily a sector that everybody should embrace. Now, if we turn from the commodities to precious metal stocks, GDX and GDXJ are easing back from overbought, but the uptrends in those are very powerful, as we'll see. It's a volatile sector, there's no question, precious metals, but it does look set to trend for years to come. And if you look at what governments and central banks are doing with destroying the financial system or debasing currencies, it's not hard to imagine that there's going to be a major reallocation in funds around the world to a higher level of precious metals. And I talked about that last week. The fact that relative to the amount of money in the S&P, GDX was holding something like 0.2% of the money that was invested in the S&P stocks, and that is illogically low in this sort of environment. Also, apart from the mining stocks, don't ignore gold, which is the Australian ETF for exposure to gold, and GLD, which is the US based exposure to gold. So I think holding some exposure to the metals as well as the miners is probably not a bad idea. The stocks are going to amplify the moves in the metals, and typically by a factor of 2 to 3. So if the metals go up 10%, then the stocks are likely to go up by 20 or 30%. All right, let's look at some charts. So we'll go first of all to the US dollar on a weekly basis. This is the high in 2011, and we can see just how strongly gold came out of the GFC. So it was trading down here around 700, and it went to 1900. Now we've definitely broken out. We're maintaining this very, very strong uptrend on a weekly basis. We did dip out of it during the crash, which was really just about liquidity, but we're still well and truly holding within that very, very steeply inclined upward channel. If you look at it on a daily basis, you can see we had a pullback on Friday in gold, and the first Fibonacci level, or the first main one, comes in at 1636. But I'm also looking at where the 20-day moving average might be, because this has been such a strong move that it's likely the 20-day moving average might also offer some support. So that's where I sort of come up with this 1630 to 1670 sort of support range for gold. Now, if we look at silver, I want to look at this on a big picture view. This is what silver did coming out of the GFC. So there's November 2008. Silver was trading below $10. It hit $50 in May of 2011 before it declined a lot. So you can see it's a lot more volatile. It went up 500%. Gold went up about 230%. But if we zero in at the moment, you can see that we're still in a big base. So if silver really is going to take hold again, as it did coming out of the GFC, you can see there's a long, long way to go potentially for silver. Now let's just look at GDX. So this is on a weekly chart. You can see GDX has certainly made a good move. It's moved from 16 to 30, so or even 32. So it's doubled. But again, you can see just how far GDX has potentially got to run to replicate what it did coming out of 2008. So all of these precious metals are certainly poised to go quite a long way. Now let's look at that another way. Just want to look at the spread. So this is the spread between. So this is gold divided by silver. Now you can see long term that that it tends to run probably somewhere around about here, somewhere between 60 and 70. So in other words, gold is 60 to 70 times the price of silver on a normal long-term basis. But if you look where we are now, we actually hit 125 just recently, and you can see just how far that ratio is deviated. So that means that silver has been underperforming gold by a long, long way. And yet we saw what happened coming out of the GFC. So that's why I think silver is poised to really do something special at this point in time. All right, let's move on to other things. So that's the precious metal space. Other commodities, copper moved a bit higher as the market sort of looked forward to a bit of a demand recovery. How quickly that happens is anyone's guess. But crude oil collapsed down to $18 despite Russia and OPEC reaching a deal. There's been a 31% decline in demand. The global inventories are heading for 2 billion barrels, which is just an extraordinary level. And the OPEC deal is really too late and probably not enough in terms of the production cuts. And as a result, West Texas crude has fallen 36% in 2 weeks, and that is an incredible disruption, not only to the sector, but it has enormous ramifications for the bond market in the US. So certainly that's a sector to keep an eye on. There's the spot copper chart. You can see the recovery we've had there over the last couple of weeks. And just to wrap it up, it's really impossible to project how this is going to go at the index level. I just think it's pointless. So try and avoid thinking about that. And I do get emails from people and have conversations with members where their thought process is a little bit along the lines of, well, I might just pull back from the market until things settle down at the index level. Well, I caution you on several levels. First of all, you don't need to, because there's some stocks that are doing just great, and I've mentioned some of those in recent weeks. So there's no need to pull back from the market, and it's pointless looking at the index as being your guide. It's much better to just be looking at specific opportunities. Most people are expecting a retest of the lows, but this crash and recovery is like no other. So I wouldn't be at all surprised if the historical patterns and seasonality may not apply this time. Now, for those out there that like to try and second guess what it is I'm thinking, I'm not making any projection there at all, or I'm not saying that a retest won't happen. I'm just merely observing that this has been such an extraordinary period that if you are relying on the historical way that things normally play out and the normal seasonality that would apply, which is, I'm sure some of you have heard the expression sell in May and go away. There is a seasonality to the market through the Southern Hemisphere winter. But those patterns may not apply this time, so I wouldn't be too hung up on them. My overwhelming recommendation is focus on the best stocks in the sectors that have got long-term tailwinds. So that's the first point. And the second point is be mindful of where the current outperformance is. It's not that hard to find stocks that have held up very well through the crash and are outperforming many of the other stocks. So for me, we just go and do what is currently working. And that's what I'm going to be covering in Portfolio Analyst this week. It's where the strongest sectors are and where the best opportunities are. And I'll be introducing another outstanding local growth stock as well. Plus, there'll also be a bit of an update on the 10 baggers, which have taken a fairly big price hit, but the businesses, if you look at the businesses, they're pretty much intact, and they're probably all going to bounce back, pretty well. So that's it for this week. If you want to find out more, there's my website, and if you want to speak to me, then there's my email address. So that's it for this week. Cheers.